the large deficits in general are stimulatory. So the fact that money's pouring out into the economy through Social Security, Medicare, defense, that goes to seniors and their consumer spending. That goes to the healthcare sector and their workers and their spending. That goes to defense sector, their contractors, their employees, all of their personal spending, interest expense. That does kind of pour out into the economy and stimulates certain parts of it. So the challenge here is that to actually cut those bigger four, it actually is there's unpopular decisions to be made.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today's guest has long been warning that the US, as well as many other countries, is now in an era of fiscal dominance. That's when fiscal spending gets out of control, like a runaway train. It becomes so large that it becomes the primary determinant of economic growth and inflation, steamrolling over any impact of monetary policy or private sector lending. At the time of this recording, the deficit for the 2025 U.S. fiscal year is on track to be the third largest in history, only behind the COVID emergency spending years of 2020 and 2021. The key difference, of course, is that this time we're not facing a global pandemic and economic lockdown. Yet the profligate deficit spending continues unabated. What impact is this having on the economy, asset prices, our currency's purchasing power, and social stability? For answers, we're very fortunate to welcome back to the program Lyn Alden, investment strategist and author of the book Broken Money: Why Our Financial System is Failing Us and How We Can Make It Better. Lyn, thanks so much for joining us today.
Thanks for having me back. Always happy to be here.
Thank you, Lyn. Very much appreciate that. And look, we're going to get into cover as much territory as we can today. But I'm going to let folks know that one topic that we're not going to address today, because we're going to address it in depth at the upcoming Thoughtful Money Conference that you are speaking at. We're going to reserve your thoughts on Bitcoin and crypto for that conference. But folks, yes, Lyn is returning as one of the esteemed faculty members for our online conference. Again, that's coming up on Saturday, October 18th, so it's just a few weeks away. Again, we'll be diving deep into her thoughts on Bitcoin and crypto, and there's lots to talk about there right now. If you haven't got your ticket yet, just go to thoughtfulmoney.com/conference and buy your ticket there now, and buy it there soon so you get the lowest early bird price discount we're offering while it's still around. All right, Lyn, I was thinking about how to kick off this discussion with you, and was looking back at your book and realizing I think we've pretty much coming up on the 2-year anniversary of that book being published. So I'm curious, have things unfolded since then pretty much as you expected, or have there been any things along the way that have surprised you?
So they have. Yeah, we just passed the 2-year mark, and it's certainly been a fun ride. I purposely wrote the book in such a way to make it as timeless as possible. So
Mm-hmm.
instead of kind of predicting what's going to happen 1 year, 2 year, 3 years out, it was basically really high level view of what money is, how technology changes structures of money and power over time, and how things, could look like years and decades in the future, and what kind of the big branching decision points are. The part that's probably most relevant for these past couple years is the chapters, kind of the middle chapters of the book, which focus on the U.S. long-term debt cycle. Your intro talked about the fiscal dominance that we're in, so that has continued to play out. In addition, the uh, the trade deficit aspect. So I had a chapter called "Heavy is the Head That Wears the Crown," which of
Mm-hmm.
course is it's a much older reference, but that goes kind of to the idea that the U.S. structural trade deficits are indeed a pretty big deal, and they're kind of tied to the global reserve status. And so since that book came out, obviously trade has been greatly elevated in political discourse, largely because of the Trump candidacy and then the administration. The other factors that I published Broken Money during a deep Bitcoin bear market, kind of wrote it and published it during a bear market, and of course Bitcoin has more than quadrupled since then. The book takes a pretty favorable view on the asset, so I would say that's not surprising, even though I wasn't trying to make 2-year predictions with the book. Um, so a lot of things are kind of going as expected, for better or worse. Some worse, some better.
Okay. I was going to get to this later in the discussion, but let's bring it up here since you mentioned it. So one of the things that's different since you published the book is we have a new administration in place that has quite different economic and trade policies than the administration that was in power when you wrote the book. Um, what What's your general reaction to the new administration's policies? And maybe if we could start, what letter grade would you give the policies, looking through the lens of the broken money thesis?
Oh, it's hard to give a single. I mean, there's so many policies. It's hard to give one grade. I think the priorities that they're tackling from a fiscal sense, I think make a lot of sense. I've been on record before saying that I think, for example, the fact that the Trump administration elevates trade as being a pretty big deal is the one of the right things to focus on compared to prior administrations. Their solutions for addressing it, I think, are more mixed. That's why I'm probably more critical of their actions. And we can also kind of compare their outcomes compared to their expectations. So a lot of things untangle there. One, we a part with Sam Callahan, and we published a report. We wrote it in 2024. It was published in January 2025. It's basically talking about the fiscal dominance thesis, kind of reiterating the nothing stops this train fiscal dominance view that I've been talking about. And it kind of broke down why DOGE wouldn't work. The Department of Government Efficiency. That was kind of
Hmm.
back during the peak publicity for that. That was kind of the peak optimism. We broke down kind of mathematically why that was very unlikely to work. And so in the months that followed, that all kind of, it had obviously shock and awe, certain political implications, but in terms of actually impacting the budget deficit, mostly a nothing burger. They were originally throwing around numbers like cutting 1 trillion off the deficit within a couple years.
Hmm. I
Um,
think 2 trillion was even the starting number,
yeah,
but it
two
got
trillion was the
shot down.
starting
Yeah.
point. Yeah, we quoted that, and then they were kind of bringing it down to like 1 trillion. But it's mostly going to be a rounding error. Other than certain political things were targeted, but from an actual number standpoint, because they as we point out in that report, they couldn't go after the key things really: Social Security, Medicare, defense, interest expense. They were going after the slice of the pie chart that is not the biggest thing. Not to say that there's no waste there, of course, any sort of large entity, this is going to have plenty of waste, but actually the biggest area of spending tend to be lower employees and major transfers. So Security,
Hmm.
Medicare, that's not where there's lots of employees, but that's where a lot of money's spent. Um, and so that kind of is going along as expected. The tariff one's interesting because Stephen Miran, he was Trump's uh, chief of his Council of Economic Advisors. Now, of course, he's his Fed appointee. He published an interesting report back in November 2024, so right after the election, that kind of walked through how you would restructure trade and what the risks and kind of approaches there are. It's kind of a more academic treatment of the subject. Um, and they intended that when you're kind of doing this big tariff policy, you'd likely get a stronger dollar. It would increase your negotiating position. You could get all these deals in place, and then you could have some sort of Mar-a-Lago accord, weaken the dollar, and go toward kind of a more, kind of back to a global, to kind of a new global system with those negotiations in place.
Hmm.
The challenge is that the dollar weakened during the tariff negotiations, and a lot of the deals are more like kind of optical understandings rather than kind of detailed breakdowns. So it's more of a headline driven administration, especially when we talk about fiscal stuff or economic stuff. The thing I probably monitor closely, the most closely, is the tariffs, because those are some of the numbers that affect macro scale things pretty significantly. When you go from an annualized tariff rate of tens of billions of dollars to hundreds of billions of dollars as we have, that does have kind of economic and macro implications. So I've been tracking that pretty closely. There's upcoming kind of Supreme Court decisions potentially, so those will be kind of interesting to watch.
Okay. Supreme Court decision aside, do you have a distinct point of view on the tariffs on a net basis? Are they a net good thing because they either help us negotiate better trade deals, although it sounds like you think we're not getting substantially better trade deals, or it's bringing money into America's coffers, or are you more on the side that look, it's a tax on the American people at the end of the day, it puts friction in free trade, maybe it pushes some allies of ours into the hands of others?
So I think it's mostly a tax on Americans. Now, there's data you can look at to see what kind of proportion it might be, and it's a moving target over time. So what complicates it is when the tariffs are being kind of considered, there was front running of imports. Rational entities said, well, tariffs might be coming, so let's buy a lot of stuff in advance. So quarter one of this year was kind of a stocking up quarter.
Right.
Then of course, we're going through quarters two and three, finishing up three here. Um, so the numbers are kind of all over the place. Aside from the weaker dollar, which weakened a lot this year, but it only went down a little bit since Liberation Day.
Hmm.
There really hasn't been a case, like a broad case of foreigners paying the tariffs, right? So in order to offset, say, 15 or 20% average tariffs, you need greater than 15 or 20% price decreases. Um, and so there's been kind of minimal to any foreign reduction in prices, meaning that they're not really eating the tariffs on their margin side per se. It's still possible they could eat it on their volume side. But so far, it's mostly a tax on Americans. I think the bigger impact is that it affects the deficits more so than it impacts trade. One of the complicating things is if you're a capital allocator making a multi-decade decision to do some sort of big capex, it's hard to make that call if you don't know if tariffs are going to be in place for 1 year, 2 year, to the end of the administration, or into the next administration. It's hard to kind of do that calculus to determine what to do. So that's kind of been the most challenging thing quantitatively when you look at, say, 30 billion a month tariff. That's 360 billion annualized, potentially trending a little higher. That's up against a $2 trillion deficit. So it's not immaterial, but it just kind of
But
mildly
it's not
slows,
enough.
yeah, mildly slows the train. And I think a lot of people would rather see some of that in especially things that affect, the majority of Americans. I think they'd rather see it in trimming certain things than raising taxes while keeping spending kind of fully going. So, that's kind of where I'd be somewhat critical from a fiscal standpoint.
Okay, smaller question followed by larger question. Um, Given your point about sort of the reticence of corporate executives to commit CapEx in an environment where things are still uncertain, and we know for sure from reports, surveys and whatnot, that they were not making a lot of capital allocation decisions in Q2 and probably still somewhat in Q3. Is there a lag effect from that? In other words, there's economic activity that otherwise would have happened that didn't happen and might still not be happening. And so, is there a lag effect that we should expect on the economy in the next coming quarters where they'll be slower than they otherwise would have been because of that delayed of activity?
I think yes, but that's only one variable among many. The large deficits in general are stimulatory. So the fact that money's pouring out into the economy through Social Security, Medicare, defense, that goes to seniors and their consumer spending. That goes to the healthcare sector and their workers and their spending. That goes to defense sector, their contractors, their employees, all of their personal spending, interest expense. That does kind of pour out into the economy and stimulates certain parts of it.
Hmm.
But then, yeah, there are other drags of basically uncertainty is a drag. Um, PMIs are still fairly weak. We've seen a little bit of an uptick in initial jobless claims, but still the labor market is overall in decent shape. Um, and the majority of these things, like a lot of investors will have a very political lens on how they view things. And while politics does matter, it's kind of like the 80-20 rule. Like a lot of these things are bigger structural things that kind of cross administration. So, for example, with say oil and gas, one thing I think the administration's been better at has been being more allowing of drilling and things like that.
Right.
But a point that I
Pro-production.
exactly, but a point that I've been making since the prior administration was the kind of the fact that U.S. production's kind of peaking and kind of rolling over is more of a private sector decision. So the constraint wasn't necessarily, at least except for around the margins, it wasn't really that kind of from the administration.
It
It was
wasn't the
more,
government policy that was the limiter. It was
y-
the corporate decisions. Yeah.
yeah, and that was mostly due to price, which is, basically without kind of there. Back in the 2010s, they were kind of very liberal on putting money back into the ground. So drill more, increase the price. Now, shareholders they generally want better balance sheets, dividends, share buybacks, and to only drill when there's a pretty high ROI associated with it. They want profitable drilling,
Hmm.
and at current prices, large parts of it is just not a very high conviction decision. So they've been more reticent to drill. Now releasing some of those frictions on them could around the margins keep them more elevated than they might otherwise have been in some sort of counterfactual. But a lot of these things are structural, that they're more price driven. So depending on what's happening, in the broader market, or they're demographics driven in the case of large swaths of the deficit. And so these things, while political changes matter for a lot of this, that's kind of the part of the iceberg we see and everybody focuses on, and it's headline driven. Whereas the bigger part of the iceberg is that underneath part that's kind of more structural in many cases.
Right, and you can chip away on the ice above the waterline that you can see, but you're not affecting the majority of the mass of the iceberg. All right, I'm gonna continue mangling my analogies here. So I said in the intro that the fiscal deficit's sort of like a runaway train. That obviously was an homage to your line there, Lyn, that nothing stops this train. And you're kind of, in that case, you're comparing the train to our fiscal deficits, that they're, hey, for many reasons, some of which you've already alluded to, they are likely to continue going forward until this experiment, has a reckoning. And we can talk about that perhaps in a moment. When you envision the train, is the train primarily made up of four cars, being those big four you mentioned: Social Security, Medicaid, Medicare, defense, and interest on the debt?
For the most part, yeah. Medicaid, I kind of lump in with Medicare somewhat. That's a little bit more trimmable, as we saw in the recent like the Big Beautiful Bill tackled Medicaid a little bit. So that one's kind of the one that's a little bit more negotiable of them. But yeah, but it's mostly those big areas. And everything else in the pie chart, you can trim little bits of it, but those are rounding errors compared to those really big things. You can also lump in veterans benefits in with defense. It's kind of like our past defense decisions now give us obligations.
Yep.
And so those are the really big, hard to cut areas. And I think one of the the premises behind DOGE was the idea that there's so much waste that we can cut things that are not really popular. The other way around, that we can avoid cutting things that are popular so we can trim expenses without really feeling it. That was kind of the thesis. It's kind of like growing away out of the debt. It's something that you can commit to that doesn't actually promise to punish anyone or lose votes.
Right.
Like who isn't against growing, or who isn't against cutting waste, right? And if
Right.
you kind of
Removing
state
fraud. Who's going to be on the pro fraud ticket? Yeah.
exactly, so those are good things optically. But then the question is, when we talk about this $2 trillion deficit, how much of that is waste versus how much of that is popular programs going to voters that vote for those things, or lobbyists that pay to get those politicians and to keep that gravy train going. The biggest sources of waste are in basically the healthcare and defense areas. Social Security is just more of a demographics issue. It's basically past decisions of how they tweaked the payouts and things like that. They always kind of
Hmm.
assumed larger generations, whereas we got obviously a lowering birth rate, a more shrinking generation thing. So the challenge here is that to actually cut those bigger four, it actually is there's unpopular decisions to be made, either against voters in some cases, or against major lobbyists in some cases, or against when it comes to defense, every congressperson that has anything in their jurisdiction that might be receiving defense related spending
Yeah.
is going to try to
It's a
protect
jobs
it,
issue. Yeah.
whether or not it actually contributes to our national defense effectively or not.
Yeah. Yeah. Okay. So, but again, point being, those four things are by far the biggest, right? They make up the bulk of the iceberg
Yeah.
that's under the water. Going back to that analogy, and while there probably, is some fat to trim off of there, and we know DOGE has tried to do that already, and Big Beautiful Bill and a few other things are doing that. But primarily, you're saying, it's mostly muscle and bone, and so to the extent that they're hard to cut because they're painful like that, it's muscle or bone. So you either have to basically default on your commitments, right, to a certain extent, like, hey, we're going to means test Social Security. You're not going to get it till you're older or whatever, or we're going to cover less things and Medicare, whatever, which highly, highly unpopular. Uh, and then I guess in the case of the national debt, I mean, it explains why the administration is so hell bent on trying to get bond yields down, particularly, on the short end with the Fed, so that it can, at least in the short term, start rolling over debt over at a cheaper rate in the short term. So there is some stuff that can be done there, but that's hard to do. You can't just pull out a wand. You can't lower the bond yields by executive order, right? So this stuff is really hard. Okay, let me ask you this, Lyn. So I'm sorry. Where I was going with this is that's kind of why you get to this no one stops this train, right? It's just the political will just isn't there to cut the bone and the muscle the way that it would need to be done to get that stuff down. And in certain cases, there are things that the administration just really can't control. It can't control really the demographic makeup of the country. It can't really control where the 10-year is. I mean, there's some stuff it can do around the edges, and maybe if it got super draconian, but then or interventionary, but then there would be other prices to pay. So you come to the conclusion that, well, yeah, like we're kind of stuck with these runaway deficits for the foreseeable future.
Yeah, they're a Gordian knot that's very difficult to untie. The interest expense one's interesting because every point cut on the short end obviously will cut the short end part of the debt, but it doesn't necessarily cut the long end
Right.
portion of the debt. Now the Fed could do outright yield curve control if it's kind of pushed to politically. That's kind of a loss of central bank independence, and it has certain inflationary implications when that happens. So there's no free lunch there really. Um, and probably the longer term, I mean, it's salvageable in the sense that very long-term decisions could eventually, along with basically certain defaults and devaluations, get it under control in the sense that like healthcare is one of the biggest areas where long-term efficiency gains could be helpful. Not just in terms of like, firing some employees or things like that, but it basically in terms of the country being healthier. I mean, on Twitter, you're always posting your lifts, which is very are impressive. Basically, one of the structural problems we have in the U.S. is that our healthcare costs are like the most expensive in the world, despite at least for the majority, not necessarily having better outcomes. So not like longer life expectancy,
Right. But
not
poor
lower.
outcomes. Sorry,
Yeah,
but I
yeah.
mean, it's not even not as good, or yeah, it's not better. It's actually versus most of the developed world, we're worse.
Yeah, worse on average. On certain leading edge things, we're near the top,
Sure.
and in certain times, but it's very heterogeneous. Um, and it's part. I mean, it's a diet issue. It's our specific structure of the healthcare system issue. And some of that long term, if there's a lot of people kind of focusing on it, could be untied. That Gordian knot could be cut. But that's I wouldn't have optimism that's going to be undone anytime in the next few years. So in any sort of, and then it would take years to actually probably have its kind of positive effects manifest. So in
Sure.
any
And
sort
sorry to
of,
interrupt, but I'm just curious also, given the lopsided demographics we have right now and the fact that most of your medical costs are in your last years of life, we have like 20 years of the largest generation entering their last years of life, right? So there's going to be just a big bill to be paid from that alone.
exactly with the one caveat that, for example, Japan is the median age there is 10 years older, and they pay a smaller fraction of what we do for healthcare, because a lot of it's health. A lot of these kind of like long-term lifestyle diseases and things like that. That also really contributes to the total healthcare burden.
Hmm.
In addition, the common statistic that we pay more per pill than other countries pay for the same pill, in many cases. So there's a whole bunch of factors there, but yeah, everything else being equal, the demographics are a gigantic variable for why that's really hard to tackle. And so the challenge is that a lot of this is locked in any sort of like investable time horizon of 5 to 10 years. So when I talk about the nothing stops this train thesis, I kind of point out into the 2030s. Any more than that, the glass gets murky because
Yeah.
politics could look totally different. I mean, you could have a war, who knows what happens. But basically, in any sort of investable time horizon, that's the view. That's locked in pretty much.
Okay. So I want to try to connect, or maybe ask your thoughts about, is it worth it to try to connect your train, your runaway train of fiscal dominance with Mike Green's, concept of passive capital flows, and he calls it the giant mindless robot. Um, is there a connection between the two, even just in the fact that they're kind of these two things that are right now, they're just driving the action, and at some point they might not, and the world could be very different if they weren't. But we can kind of continue to project all right, if this continues the way that it's going, you know, then it's going to drive the action to kind of this general predictable point. So like in with you with the train, the further that train barrels, out of control down the track, we know the debt's going to get bigger. We know the deficits are going to get bigger. We know that the purchasing power of our currency is going to diminish as a function of that. And therefore, that informs your investing decisions, right? Okay, I probably want to be in hard assets and things that can't easily be inflated away, right? That type of thing. I probably don't want to be in bonds if inflation is going to be secularly higher because of all this. Um, the giant mindless robot, in some ways is kind of fed. I think as long as money is sloshing through the system, it probably help. And as long as there's deficit spending to keep people employed, that keeps the passive flow, or the passive bid, well in place. Um, is there a connection between the two, and does it make sense to sort of think about them as somehow linked?
I view them as there being a connection, and it partially ties into fiscal, but I'd say even more it ties into the trade aspect.
Hmm.
So to recap for a second, like in Broken Money, I talked about this certain articles that there's a cost to being the global reserve currency. I mean, it goes back to the economist Triffin talking about this, of
Griffin's
course.
dilemma, right? Yeah, famously.
And it takes a couple different forms, but basically, the whole world needs dollars. The world uses dollars as its biggest ledger for international activities. So most currencies trade on interest rate differentials, current account balances, things like that. The dollar trades on those, but then it has this additional overlay of all this excess kind of inflexible demand. For using the dollar as a reserve asset, using it as a global funding currency. So if you lend money to an entity in another country, it'll often be in dollars.
Yeah, and sorry,
Using
but this is what's referred to as the euro dollar market, right?
Yeah, exactly.
Mhm.
And then also the dollar is on 90% of foreign exchange trades. So, for example, if you want to get out of Egyptian pounds and into Korean won, that might not be a very liquid market between them. There's over 100 currencies, so the number of combinations is massive. Most of them are not very liquid, but most of them are liquid with the dollar. So you can always go one to the dollar and then dollar to the one you actually want to go to,
Yep.
and that represents by far the majority of trades. And it's also the unit of account for a lot of international contract pricing. So there's all this excess demand for dollars. And then the question is, how do they get all the dollars to do all that? And the answer is that we pour it out every year into the world through trade deficits. And it's not even necessarily an intentional decision because by all this excess demand for dollars, it basically boosts our import power. It kind of artificially increases our currency strength compared to what it would trade on based on trade, based on interest rate differentials. We have
Hmm.
this extra premium, so it boosts our import power and then it hurts our export competitiveness specifically for a lower margin stuff. So like manufacturing more so than say tech or healthcare. That's
Hmm.
like high enough margin that it can ignore that effect, whereas low margin stuff can't really do that. So we spew the dollars out into the rest of the world. Now, partially they float around and stay out there, but then the countries or the entities in the countries that have a really big persistent surplus, they want to do something with the dollars. And so in many cases, they reinvest those back into the US. So they go and they, for some markets, it's their real estate market. So in Canada or in Australia, foreigners will buy their real estate market. In the US, it's primarily our equity market. Our equity market's it's the biggest, deepest, most liquid capital market in the world. Equities along with bonds. It's kind of the jewel of the world's capital markets.
Hmm.
And so all this kind of global dollar capital then gets reinvested in the US. And so when we are kind of running a persistent trade deficit with the world, we're getting more goods and services, but really instead of sending them dollars, we're sending them pieces of our businesses and to some extent pieces of our real estate, pieces of private equity, things like that. But especially our publicly traded equities, we're sending pieces to them because we're sending dollars and then they're buying a greater and greater share of our equities. And
Hmm.
so that's where there's a connection there because that's kind of a big dumb robot. That's just on autopilot. It's entrenched into kind of being the global reserve currency, and all this capital is every year is kind of flowing into the U.S. So I mean, some of it is literally passive. Other ones might as well be. It's basically roughly market cap weighted. So it's just kind of piling into whatever the biggest, most liquid stocks are. Roughly speaking, the S&P 500 or the Nasdaq 100, and so that's kind of that structural flow. And then also because there's all that extra excess demand for dollars, it allows Washington to run these bigger deficits without immediate punishment. So, for example, Brazil got into a problem when they were running a similar deficit as a share of GDP as we were. But the difference is there's not like global entrenched demand for Brazilian currency. So any sort of emerging market, when they run something like our playbook, the market freaks out right away. Global capital pulls away, and they have to kind of adjust. Whereas the U.S., we're kind of given more rope to hang ourselves with,
Hmm.
and so our trade deficit and our fiscal deficit are somewhat tied at the hip, and they're somewhat tied to the global reserve status. And because that gigantic engine is just in place, that capital gets reinvested into our biggest companies, which is where you get, I would say, that connection to the passive flow and the big dumb robot. And where that could potentially be reversed is if you do policies that potentially reduce imports and you do policies that and or weaken the dollar, you could get a gradual reversal of some of those flows. You don't have to like pull a lot of capital out of the US, but if you just kind of
Hmm.
slow down the flows that are
Right.
going into it, or even just get to neutral, that can be a pretty significant effect on capital markets or on the currency itself.
Okay. Super useful. Thank you for connecting all those dots. And so let me try to take the beam a little bit more near term. Um, so, next 6 to 12 months, we are sitting here at a moment where stocks are more or less at all-time highs. I don't think they're on the day we're recording, but they're super close to it. Um, Actually, almost all assets have been kind of moving up in sort of almost a combined melt up over the past month or two here at this point. So correlations have sort of moved to one. People who care about valuations, which isn't everybody, but look at them and say, man, these are the most stretched metrics in many cases we've ever seen before on record. So you combine that with an economy that appears to be slowing now, a jobs market that no longer appears to be normalizing the way that Powell has been telling us all year, but now really appears to be weakening. Um, we might have this lag effect even in the next couple of quarters of the economic activity that should have happened but didn't kick into gear as well. So I guess first question is uh, recession risk. High, low, medium. What do you think?
I view it as medium in that time frame. And probably one of the biggest factors to watch there is AI Capex. There's somewhat of a kind of a flywheel there.
Hmm.
And it's of course one of those things where the big winners so far have been the chip makers, the data center makers, and whereas like a lot of the actual AI services are not profitable yet.
Yeah,
So
and
they're
sorry to
funded.
interrupt, but the analogy that's come to my mind, it's like the old gold rush in California. It's like the guys selling the picks and shovels are making a ton, but we're not really sure too many people have found many gold nuggets yet.
Yeah, and now it's kind of like the pick and shovel makers are kind of also investing in those people to go out and keep doing what they're doing.
Yeah,
So it's a
they're
little.
almost giving them the capital to then continue to buy their products, which smells very much like the dot-com-y, questionable financing that was going on.
Yeah, I think we could temporarily get over our skis there and have a pullback. It doesn't mean that technology is not real. It doesn't mean it's not going to change things substantially
Yep.
over the next 5, 10 years. But it just means that you can get kind of like how building fiber optics got over its skis in the dot-com era
Yeah.
and other things. So you could certainly. It doesn't mean the internet wasn't a big deal. It obviously was. But
It,
that's
it,
kind
it
of how
just
I.
took longer for the value to get created. No, absolutely. I think that
Yeah.
analogy could be very true here. Yeah.
Yeah, so I think that's probably one of the key variables to watch in that time frame of 6 to 12 months, because that's if you kind of separate AI related capex to like everything else, it's like two different economies basically.
Yeah.
The same thing's generally true for valuations. Like for example, if you look at U.S. banks, many of them are very reasonable valuations, and they're profitable, they're doing fine. Whereas like you look at Costco and it's trading at 50 times earnings,
Right.
and when you look at index wide cyclically adjusted price to earnings ratios, so CAPE ratios, very high. Market cap to GDP, these are all very high. But it's very concentrated in the top 10, 20 names. And so, and one, of course, one of the downsides is if you do get a weaker stock market, you can get that wealth effect kicking in. So then wealthier investors are a little bit slower in their spending. because they're a little bit spooked by the economy, by the market, and then you
Right.
can get kind of a self-fulfilling prophecy. So instead of the stock market reflecting what's happening in the economy, sometimes the economy reflects what happens in the stock market once you
Right.
become this financialized. Um, Now, but the caveat I would say is that recessions look different under fiscal dominance. We're already
Hmm.
pre-stimulating by 6 to 7% of GDP fiscal deficits per year.
Yep.
And so in some ways you get more of like an emerging market light recession, which is another way of putting it is so back in 2022, we skipped having an Enber defined recession, even though the misery index, so the combination of unemployment and inflation, spiked to recession levels, mostly because of the
Hmm.
inflation component. Consumer confidence absolutely collapsed to recession levels. PMIs were sub 50. If you look at the Conference Board leading indicator, it's been flashing recession for the majority of the past 3 years. It kind
Right.
of briefly got out, then went back down. Um, PMIs, I think I already mentioned those. Those are super low. That's one of the factors. So a lot of these things are flashing sometimes red, sometimes yellow warning signs for a recession. But the two things that have been supporting it is one, the labor market hasn't cracked fully, and two, partially fueling that is those deficits. So if you have real estate's slow and commercial real estate's basically depression, manufacturing's stagnant, but you keep pouring money out to Social Security, Medicare, defense, interest expense, all these other things, and then that trickles into the rest of the economy through employees, contractors, contracts, all that spending just kind of diffusing out there.
Hmm.
It's this big lift, and you risk getting more stagflationary type of environment where you don't get some big disinflationary implosion in the way you might get, say, of a global financial crisis, something like that, but you get more of a malaise where inflation's
Yep.
still above target, and yet also cracks, early cracks in the labor market and things like that.
In fiscal dominance, when you have those, let's call them shallower recessions, but they're these periods of malaise. I don't know, but do you get more of them? So they're not, it's not like a big bust like 2008 or 2001, but it's more you dip into it, maybe you get out a little bit, you dip back in again, or is there no
You
pattern
could,
like
you
that?
you could. I mean, that's where the Conference Board leading indicators kind of pointing that you kind of are in mild recession, a little bit out of mild recession, then back in mild recession.
Hmm.
That could be common. It depends on details. An example I can point to, we were talking before we got up, before we recorded that about Egypt. Uh, a lot of viewers might know I spend time in Egypt, and for example, over the past 10 years, if you look at say per capita energy consumption, it's been flat to down. And if you look at, let's say over the past 5 years, the labor hours it takes to buy a car there, especially the same model of car, has gone up. So people have to
Hmm.
work more hours to buy, an imported computer, an imported Volkswagen, whatever the case may be. Um, and so the instead of kind of being an unemployment spike and then back to growth and unemployment spike, that emerging market style recession is kind of everyone's vaguely poorer, or at least a lot of people are vaguely poorer, and they're not 100% sure why. A lot of it's the currency itself. Um, a lot of it's kind of like weaker productivity going on. And in their case, productivity partially saved them in the sense that that was also during the time where Chinese vehicle exports ramped up dramatically. They became the biggest auto exporter. So
Yep.
they're now producing decent quality cars for cheap. So that is like a substitute that Egyptians can and do switch to. But if you look at like the same car, like a Volkswagen or something, that's where the recession kind of really shows up. And so I think that's a more extreme example. I mean, they were dealing with a official like 38% inflation at one point in recent years. But you get kind of the milder version of that, which is everyone's kind of saying something doesn't feel right, or things aren't booming, even if they're not exactly collapsing. They're just
Hmm.
kind of rolling along and being partially hidden by 7% of GDP deficits and ongoing debasement.
Right. And Lynn, I'm going to guess you probably hear from a lot of the same people I do who are contacting me and saying, that's how I feel right now, right? I'm being told, look, GDP is over 3%, stock market it's at all-time highs, unemployment's at, near historic lows. But personally, either I feel like I'm in a recession or I just feel like I'm falling increasingly behind. Is that a feature of fiscal dominance? Not a bug?
It's a common feature. So fiscal dominance can take different forms. For example, the last time the US was in that World War II era. And a lot of the deficits were actually poured into the bottom half of the economy. It was poured into soldiers, it was poured into manufacturers, it was poured into the soldiers coming back and
Yeah.
being subsidized to buy houses. It wasn't really pouring into the top as much. And it was combined with like pretty draconian tax rates as well.
Right.
So basically bondholders and rich folks got kind of squeezed in various ways. Obviously handful if you're on the right side of some of those deficits you did well, but for the most part, it kind of pulled out of the top and cycled into the bottom through inflation. Whereas at the current time, it's getting sucked at in multiple parts and kind of put in sometimes to the top, sometimes to the very bottom. But basically, if someone is not receiving a ton of government aid or anything, so maybe they're working class or middle class or in that kind of ballpark and younger, they're not really on the receiving side of deficits in many cases. They're not receiving Social Security, they're not receiving Medicare. If they don't work for defense, they're not receiving that. So they're kind of on their own, but they're on the wrong side of tight monetary policy. So mortgage rates and mortgage expenses are super high. They're also suffering the inflation from the fact that those deficits are pouring into others. So if you give deficits to say Social
Right.
Security recipients, they go out and spend it. It keeps prices elevated what they otherwise would be. And if you're not the receiving side of the deficits, your egg prices or whatever is going, your grocery prices are going
Right.
up, but
You
you're
eat the cost of living and you have no relief on the other side of the ledger. Yeah.
exactly. So where you are in this matters a lot. So um, it, that's the problem. It's very heterogeneous. It is a two-speed economy. It's not quite as simple as rich and poor or old and young, but there are certain directions there that are
Yeah.
generally happening, and that's where you get a lot of that feeling like, well, the numbers look fine, but I don't feel fine. And actually, the same thing happens in Egypt, which is officially the GDP per capita is up, but then it's like, if energy per capita is down and it's a developing country, so energy is not high to begin with. It's not
Yeah.
like, in America, we have so much extra energy that our energy per capita is not necessarily telling a lot because, mildly more efficient appliances or, things like that can tweak things, or shifting our manufacturing overseas or something. Whereas Egypt's got like 1/8 of the energy consumption that we have. So the fact that their energy consumption is flat to down, brownout rates are going up. So you know, things just like the power grid going out during parts of the day in the summer in the Saharan desert. Um, that's what they feel, and then they see the numbers that say, well, but the numbers say it's up, and we again we have a milder effect, I think, of that in the U.S., which is there are pockets that are doing well, but the people should believe their eyes to some extent.
Yeah. No, I think that that's sort of the increasing risk we run here that I'll ask you more about in just a moment here in terms of purchasing power decline. But just one other thing to mention. I mean, I agree right now that there's stimulus at different levels, but it's hard not to argue that it is highly correlated with those who own assets,
Yeah,
and also highly correlated with age. And that's just because age is correlated with asset
yeah,
generation or asset accumulation. Um, and I think that is an output of fiscal discipline, which is that it artificially props up asset prices. But disabuse me if that's wrong. But if it's not, then yeah, I mean, it explains a lot. I think I just saw the latest stats that, what is it? I think it's less than the top 10%, but I'll say the top 10%. They control, I think now over 50% of all consumer spending. And if you look at the bottom 60%, I mean, I'm not even sure it's 15% of spending. Like it's almost like the bottom 60% could just stop spending altogether and it wouldn't really matter that much. Which shows the oversized advantage that the people who are benefiting from this process get.
yeah. As you point out, there are a lot of correlates there. So age and asset ownership are highly correlated. Now, obviously, there's
Yeah.
very different things can happen over the course of a lifetime. But and then also, of course, the demographics and Medicare and Social Security are obviously age dependent
Yeah.
entitlements that
Yeah,
people are
actually,
paid into.
most of the things that are on that train, those four cars, benefit the old, right? If you're
Yes,
young, you don't
yes,
get Medicare, you don't get veteran benefits. Well, I guess you get veteran benefits, but you have to have had the time to serve, right?
yeah.
You don't get Social Security.
Yeah.
So, to your point,
Yeah, and another way of looking at it is the number it used to be with Social Security, the number of people paying into it per retiree, so worker to retiree,
Was
might
high.
be yeah, it was like five people paying for every one, and then it drifts down to three and goes under three, for
Yeah, it
example,
was
and it
actually
just
when it started. I can't remember
super
exactly, but
high,
it was a
very
lot.
high.
I mean, it was in the
Yeah.
double digits. Yeah.
Yeah, very high. Um, and so that's to some extent what people feel. And of course, I want to be careful to say that there are, for example, seniors that are not wealthy, for any number of reasons, and they wouldn't want to be lumped in with, well, like the seniors are getting all the goodies because they're saying, well, I'm not getting, I'm barely getting by on Social Security, someone could say, and that's absolutely true. So it's not as simple as, of course, breaking it down exactly by age or asset ownership. Someone could own a lot of assets, but then their business is being pounded by tariffs, for example, and they're saying, "Well, I'm not in the booming camp at the moment either." So
Hmm.
there are spots of exceptions everywhere. But yeah, the general rule with loose fiscal that's geared toward age demographics combined with tight monetary policy is if you're looking to buy a house and you don't have assets yet, you're having a rough go. And if you work in an area where you're not really, for any number of reasons, on the receiving side of deficits, whereas if you've already got your assets, if you either don't have any debt attached to it or you've got a fixed rate debt back when it was cheap, and you're receiving Social Security and or Medicare, any number of those things, you're on the right side of fiscal dominance, and that's where you get that two-speed economy.
Okay. Which, kind of folks, what we're underlying here is that, there's a lot going on here. So you really need to understand the nature of the forces in play. And that's what Lyn's book and her ongoing writings do such a great job of keeping us informed of. And then figuring out, okay, how do I actively invest in this type of environment? So, okay, one or two more questions for you, Lyn, before I start having to land the plane here. Um, I just love to get your thoughts on this. So another stimulus that has been going to asset owners and largely older asset owners that like to own this asset class has been the T-bill and chill trade, right? And finally, and I'm not, I don't begrudge the fact that there has been a T-bill and chill trade because for much of the ZERP era, you had seniors, their problem was is they had worked their whole lives and saved to live off
Yeah.
a fixed income, and then all of a sudden that fixed income pretty much went away. Um, so anyways, folks have been very happy to get a safe 4 or 5% return over the past couple of years. Presumably, there's now a timer on that, an end timer on that, as the Fed resumes a rate hiking regime, and it seems that the administration looks to replace Powell and maybe even a few more people on the FOMC with more dovish people. Um, so So that 4 to 5% return on T-bills is a monthly injection. Well, I shouldn't say monthly, but it's a regular injection into the portfolios of the people that own them, and it's pretty substantial.
Yeah.
What impact, if any, or I guess what's the net benefit, do you think, of the T-bill and chill trade going away? Yes, these people will have less money to spend, but our national interest bill will go down.
Yeah, I think that it'll be exactly what you said. And that's part of fiscal dominance. That's a key part of the thesis, which is most of the Fed's tools, which is basically balance sheet size and interest rates, that's mostly around either encouraging more bank lending, accelerating bank lending, or slowing down bank lending.
Mhm.
Whereas when you already, and that works when you say, when Volcker jacked up rates, it helped because most of the money creation was from bank lending. Federal debt was only, 35% of GDP. So while raising rates did to some extent blow out the deficits, it slowed down bank lending even more, and therefore it did the intended effect that Volcker had. The problem in the current era is that when federal debts are over 100% of GDP, and the majority of fiscal spending is bigger than net new bank loan creation. So bank lending is already somewhat subdued, holding rates high, the problem is that you blow out deficits by literally a bigger dollar figure than you slow down bank lending. And as you point out, a lot of that bigger deficits goes to people's money markets, goes to people's portfolios, and it's spendable money into the economy.
Mhm.
And of course they benefit, but it's stimulus. And to some if it's older, wealthier people, then you're kind of exasperating that two-speed economy. You're basically stimulating the people that are already doing fine, and that actually gives them more spending power that then hurts people at the grocery store that aren't receiving that. That's the complicating factor. So a lot of these things have winners and losers. Generally speaking, we should expect mildly lower interest rates going forward with a more dovish Fed and cracks in the labor market, which takes the air out of the T-bill and chill trade. Um, but that also, potentially weakens the dollar a little bit, brings back a little bit of inflationary pressure, or at least sustains existing inflationary pressure. It doesn't necessarily affect longer term rates. So mortgage, like house buyers might not get a ton of relief. They might get some, but they might not get a ton. If the market perceives, and this is where where longer rates will very much matter, because if the market perceives that the Fed is doing something rational, so if they say, okay, this labor market cracks, it makes sense to cut rates, then probably mortgage rates and long duration treasury rates will also stay somewhat subdued. Whereas if the market perceives it as political, saying that, well, stock market's at all-time high, gold's near all-time high, Bitcoin somewhat near all-time high, um, the, things are running hot still, kind of, and you're cutting rates, then maybe I'm going to sell off the long end. So it depends what ratio the market perceives it as a political kind of necessity versus just kind of Spock-like decisions on economic and where you're going to trim the numbers. But basically, that we should expect a mild reduction in that spending going toward seniors, but then still all the other variables are still very big.
So very big. Okay. All right. There's one last question I want to get to and asking you. It's a little bit different from everything we've been talking about. Before I get to that, Lyn, just to kind of get to the like, all right, the so what of it all. As you look ahead next 6 months or so, and a lot of what you do is analyze and advise your clientele, what assets look well prepared for the next, for the road ahead and which ones don't. Are there any kind of clear trends right now that you're focused on?
So apart from hard assets like gold and Bitcoin, there's certain energy pipelines I like. One of the somewhat not very popular trades that I like is actually certain U.S. financials. And part of that is because there are many, medium-sized banks that I think are in good financial shape. And because of fiscal dominance, I don't expect a recession to seriously result in impairment to their balance sheet from loans. Of course, around the margins, any sort of weakened economy, you're going to get an uptick in loan issues, but I think that's already well priced in terms of how they're managing risk and in terms of how investors are pricing their stock. I actually think many medium-sized banks are worth looking into. And I've also been fairly bullish on emerging markets. Now, eventually, I think that trade will get somewhat overdone. I don't think we're there yet. So I've been, somewhat bullish on Brazil, for example, and
Mhm.
Brazilian banks and just Brazilian equities broadly, especially inclusive of dividends. So sometimes you look at these stocks or ETFs, and the stocks is kind of, it could be grinding sideways, it could be grinding up, but then it's often paying pretty big dividends depending on which one you're looking at. So on a total return basis, that's interesting. And to some extent, when you have a fiscally dominant environment, um, it's not just hard money. It's kind of some of these value equities that are not value traps. So things that are somewhat on the receiving side of the deficits. So banks are on the receiving side of interest expense as well. Depending on how they manage their loan book and their security book. I think we've gotten past the worst of their issues back in 2022, 2023. And so that's an area that I'm constructive on a name by name basis.
Okay, and obviously for name by name basis and stuff, folks can subscribe to your
Yeah.
service and they can hear your particular thoughts there. With the energy pipelines, are those mostly like the midstream companies
Yeah, I think
that we
some of
hear
those
about?
are reasonably priced, and generally there's a phenomenon where the limited partnerships, like the master limited partnerships, are better priced than the C corps. And there's a bunch of reasons for that. The C corps are easier to invest in tax-wise by foreign investors, so they tend to prop up the valuations.
Hmm.
Whereas if you're an American and you're looking to buy those long term, you can generally get a better deal by going into some of the high quality MLPs. You'll basically get a similar quality company, but generally a somewhat higher yield because there's a little bit lower starting valuation. And so all else being equal, I like certain MLPs for longer term investors, five plus year income play.
Okay. And as I understand it, so correct me if I'm wrong, in an era of fiscal dominance, bonds aren't a very good bet because you basically have inflation working against you. As you look out to the next 6 months, and we talked a little bit about, I think you gave the risk of recession as moderate. Um, uh, do you still see bonds as something you don't want to touch, or is there a potential that if we have disinflation in a slowing economy, and maybe even a little bit of a safety trade, as well as the Fed bringing rates down and whatnot, could there be a near-term trend to ride in the bond market?
So bonds are certainly tradable. It's not something I choose to focus on because I think the upside's somewhat capped. My general view, so I've been a bond bear since 2019. I think the worst of the bond market is likely over. So I don't think we're gonna have another 5 years that were as bad as 2019 to 2024. Um, and I think we're more in the slow motion train wreck part, which is bond yields are starting from a higher yield position than they were before. Um, there's certain periods where the equity market could get overvalued and bonds could outperform for 6 months, 12 months, sometimes more, even if the returns aren't great from, a 4% yield standpoint. Um, and so I do think that whether it's tips, especially for uh, retirees or other people that need kind of low volatility portfolios, I do think that bonds at these levels can play a role. Um, it just kind of understood that they're volatility reducers that are kind of treading water. They're not really adding, that yield is mostly illusionary. It's just kind of offsetting debasement and not even fully doing that, especially when taxes are considered. So it's not one of the worst things out there on a kind of intermediate term basis. But I do think that over the next 5 plus years, that will continue to be one of the losing areas um, as you have ongoing fiscal dominance.
Okay. And given all the valuation uh, extremes that I mentioned a little while ago, the fact that the market does seem to be quite euphoric at the moment. Um, do you have any thoughts on, hey, this is a time to have oversized amount of cash in your portfolio? If you still be long, but just have some buffer there, given how extended things seem to be, or are you not that worried?
So I hold a decent amount of T-bills in my portfolio. Still a fairly small position. It'd be larger if I was, say, retirement years. Um, and the other defense, instead of in addition to just cash, is to own some of the things that are not expensive. And so kind of the way I've structured my equity positions is just, avoid as much as I can some of the bubble names. Stay in names I view as kind of fairly valued but still growing and attractive on a total return basis. And there are certain years where that underperforms because the bubble stocks do really well, but then in pullback years, that strategy generally holds up pretty well. So, for example, 2022, which is really bad for like the mega
Yeah.
cap stocks in many
The Kathy Wood
cases.
stocks were down 80%. Yeah.
Yeah, they were crushed. The Mag 7 was crushed last. They at least recovered. The ARC style ones didn't fully recover in many cases. Whereas like healthcare was up, energy was great. Um, kind of other sort of value adjacent stuff was it depended. It was mixed, but it was like not as bad. So there are certain times where that strategy pays off, certain times it doesn't. I do a little bit mix of both. So that's another thing to consider. It's not just cash. It's also what parts of the market am I in? Or also another way of putting it is people often assume that if the US market does poorly, it means emerging markets are going to do worse. But when you have dollar weakness and fiscal dominance, that's not necessarily the case. I mean, for example, this year, if you ask people, okay, the U.S. is going to do a U.S. first tariff blitz, is our U.S. stocks or emerging market stocks outperforming year to date? Most people would say, well, emerging markets are probably hurt. I mean, they're the ones supposedly being tariffed, but they're doing pretty good this year. Um, and so there are pockets you can go to that are not necessarily cash, but that are kind of beating to their own drum.
Hmm.
Uh, not to say that cash isn't also useful, but it's just by having all these different segments like cash, gold, Bitcoin, emerging market equities, value equities, some growth equities too, I like. But if you have that kind of mix, any given pullback ends up being less extreme to you in most cases.
Sure. And that's, folks, the benefit of diversification in general, but obviously Lyn's taking it in a way that adds additional risk management in there. All right, Lyn. Well, look, thanks. This has been wonderful. Again, folks, I specifically didn't ask Lyn about Bitcoin and anything else crypto related because that's what we're going to do at the conference. Lyn, I'm going to wrap this up in just a minute with some housekeeping. But before I do, let me ask you this question. I noted on your X feed the other day that you posted a famous Norman Rockwell portrait that we all know, and said or asked, "Hey, does anyone know the name of this portrait?" Because it has a name, and the title was "Freedom of Speech." We've had a lot happen in light of recent events around free speech. That's caused us to reflect, I think, not even just as a nation, I think as a global society, on its role and its importance. I wanted to give you a chance to just sort of share your thoughts, if any, around what you've been mulling on free speech, given again recent events.
Yeah, I think it's important to just reiterate, especially as Americans. I mean, free speech is something that is kind of structural to how I think the country's been so successful. Um, and speech can be taken away in multiple ways. It can be taken away from violence. It can be taken away from government oppression. Some people, of course, mix it up between private actions. So freedom of speech doesn't necessarily mean freedom or guarantee of a platform. So
Hmm.
private entities could certainly take action, or there could be consequences, for certain types of speech that is either unpopular or wrong or whatever the case may be. But that's very different than obviously violence towards speech or government attempts to suppress speech. One of the areas that I've been interested in, it's not really Bitcoin or crypto, but it's kind of adjacent, is decentralized social media, for example. Back in the prior administration and before, I was really interested in alternatives to these big centralized platforms that are kind of unilaterally censorable. So having decentralized ways to go around, as well as just a general culture that uh, you know uh, is willing to disagree with people, but that will defend their right to speak. Again, not necessarily to have a platform, but that they can say what they want, and if they can build a platform, then they get it, and if they can't, then they don't. So, um, yeah, whenever we go through these times, I think it's important to kind of go back to some of our fundamental values and some of the things that have gotten us this far.
All right. Well, I completely agree, and I haven't talked about it all that much, but have talked about it, I think, enough in recent weeks to say that hopefully, this is one of those values that we can all agree on, right? As divided as this nation is, free speech is the bedrock of Western society, and is a reason that's the First Amendment here in the States, and that in no circumstances is violence an acceptable response to someone expressing their freedom of speech. So it seems like you're all right there. For folks that are
Yeah.
maybe perhaps interested in learning a little bit more about decentralized social media, is there any direction you could point them in to learn more?
There's a protocol called Nostr. Notes and other stuff transferred by relays. Like primal.net is one of the clients. But it's kind of like how when we use email, all of our different email clients can talk to each other because they use an underlying communication protocol, simple mail transfer protocol, and certain others. Whereas in social media, we're in these kind of more isolated ecosystems. Like, if you're on Twitter or X, you can't talk to people on Facebook. Whereas
Hmm.
if you're on Gmail, you can talk to people on Yahoo or Proton.
Right. Great analogy.
And so Nostr is kind of like that, where you have a open source substrate, an open source communication standard, a language, and then people can build different clients. And you could have something that looks like a Twitter clone, you get something that looks like an Instagram clone, you can have entirely your own thing, and they have their own aesthetics and ecosystems and algorithm policies, whatever the case may be. It's open source, you can build it, but then they communicate in a similar way that email clients communicate. So I did generally found that interesting. And last year, 2024, I interviewed Jack Dorsey at the Oslo Freedom Forum
Hmm.
because we were talking about that. It was so that's an area that he's been focusing on too. And for people that know his history, he had challenges trying to figure out how to run a centralized platform in a time of heat around that
Hmm.
subject. And then also he tried Blue Sky, which he tried to kind of take part of the substrate and separate it from Twitter. And the problem was that kind of got captured as well. So now Blue Sky is basically
Yeah.
kind of like how Twitter X is sort of right leaning. Blue Sky is kind of Twitter for the left. It
Left,
was
right.
not really.
Did Jack Dorsey, did he develop Blue Sky?
It spun out of stuff he kind of helped spearhead it.
Okay.
And he was initially on its board. And when that kind of didn't, I don't want to speak for him, but there are articles and quotes he's talked about. But basically, his latest focus is on Nostr, which is kind of more open source and kind of more, kind of closer to, I think, what he was intending, you could say. But basically, it's kind of the idea of ecosystems can kind of manage themselves, but you get a lot of power if those ecosystems can also talk to other ecosystems in an open source way so that, you can still filter spam and, extreme hate or whatever the case you're trying to do. With different platforms can have different policies, but then there is that underlying thing so that if something gets blocked, you kind of control your own key. Like you control your own identity that can kind of rotate to different ecosystems, kind of like how imagine if you could go to a different webmail provider but still have your emails, for example.
Right,
That's
right.
kind of how that
And it
works.
makes it harder for a central authority to
Yeah,
deplatform you, if you will.
exactly.
Yeah. Okay. No, fascinating. All right, Lyn. Well, look, most important question of the interview. Besides attending the conference in a couple of weeks, where can people go to follow you and your work?
People can check out lynalden.com or they can check out Broken Money on Amazon or elsewhere. Thank you.
Okay. So, Broken Money is basically sold anywhere books are sold.
Yep.
All right. Well, in wrapping up here, folks, please join me in thanking Lyn for giving us so much time and being so liberal with her insights here by hitting that like button and then clicking on the subscribe button below, as well as clicking that little bell icon right next to it. Again, a reminder, if you would like to hear Lyn opine specifically on her thoughts on Bitcoin and what's going on in crypto right now, and there is a lot going on right now, and it's an asset that many of you in this audience tell me you don't fully understand and want to get the insights of a good expert. That's why I invited Lyn to come talk at the conference. Then go get your ticket right now if you haven't already got it for Thoughtful Money's Fall Online Conference on Saturday, October 18th. To do that, you can just go to thoughtfulmoney.com/conference. And if you go now, you can still lock in the early bird price discount. It's the lowest price that we're offering. I want as many people as possible to get that lowest price. And if you are a premium subscriber to our Substack, make sure you check your email inbox for the emails I've sent you that have the code, the discount code you can use to get an additional $50 off of that lowest price early bird discount. And lastly, too, if you can't watch live on October 18th, don't worry. Everybody who registers will get sent replay videos of the entire event, all the presentations, all the live Q&A. Lastly, if you would like to get some help from a professional financial advisor about how to position your portfolio and your financial wealth for this era of fiscal dominance, and particularly for maybe the next 6 months ahead that I talked about right there with Lyn, then consider talking to one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To schedule one of those consultations, just go to thoughtfulmoney.com. Fill out the short form there, only takes you a couple seconds. These consultations are totally free. There's no commitments involved. It's just a free service these firms offer to be as helpful to as many people as possible. And with that said, Lyn, thank you so much. It is always such a joy having you on the program. Really is a privilege. Really looking forward to talking to you at the conference. But again, thanks so much.
Thank you.
All right, and everybody else, thanks so much for watching.